Okay, this is video number 2, and it's net present value and other investment criteria. We're going to look at different ways that we determine whether we should invest in a project or not. In Chapter 1, we talked about one of the major decision-making areas was whether or not we should invest, or where we should invest, which investments we should take, and that's called capital budgeting decisions. And so capital budgeting really is important for the long-term direction of the firm, and we need to be able to make that with using good criteria and make sure that we're making good calculation. Now, one of the things with net present value, which is a method of calculating whether we should take an investment or not, is that we're going to calculate exactly how much we think we're going to bring in, what kind of cash income we're going to have, what kind of cash outlay we're going to have, and then compare basically the present value of those and determine whether or not we should make the investment. So we get to this example here. They suggest, or in the example they say, we're going to start a fertilizing business and we're going to have $20,000 in cash revenue. And we're going to have that's every year, and for every year we're going to have $14,000 in cash outlay. That means we'll have a net cash income of $6,000 a year. We'll end the business after 8 years when we'll sell all the equipment and plant and property and get $2,000 out as salvage value. The project is going to cost us $30,000 to start, and we expect that we should have a 15% return on our investment. So we're going to use a 15% discount rate. Is it a good investment? Well, we calculate the present value of the flow of future payments, an annuity, $6,000 a year. We're going to calculate that 1 minus 1 over 1.15 to the 8th power. All of that divided by 15%. Now this, by the way, is the present value of an annuity. That's what we're looking for there. And we're going to add to that the lump sum payout and the present value of that, which is $2,000 divided by 1.15 to the 8th power. We do the math on this and we get $27,578. Well, should we do this? Well, considering we have to invest $30,000 in the beginning as an outlay, no, this is not going to recover all of our initial investments. So this is not a good investment. We would actually decrease the value of the stock by $2.42 a share if we did this. And you can see kind of what the timeline of the investment would be. Now, when we look at net present value, there's one basic rule that we should come away from it with. And if we look at net present value, we're going to compare the net present value of all of the income compared to the value, the present value of the income compared to the expenses we're going to have. If it's a positive, we're going to accept it. If it's a negative, we're going to reject it. So an investment should be accepted if net present value is positive and rejected if it's negative. Okay, so when we use the net present value rule, there's another example of it here. We're going to compare the recovery to the initial investment to decide whether we want to actually do that. Now you can use Excel to calculate net present value and other financial functions, and they just show you that here along with some caution about how you use it. I'm not going to spend a lot of time on that, although I will tell you that I do like to use Excel for a lot of reasons, and financial calculations would be one of them. So we're going to talk about now the payback period. The payback rule is what they call it, and basically what we're talking about, basing our decision making on the payback rule, an investment is acceptable if the calculated payback period is less than some prescribed period of years. So if we say we want a payback period of 3 years, and we looked at this investment, $50,000, we would say yes, we want to do this because the payback period is only 2 years. And then you're basically trying to calculate a period of time at which you recover all your money. So the initial cost here of an investment is $500. You get $100 the first year, $200 the second year. You have $300 back. You need $200 more. $200 out of the $500 you're projecting in year 3. So when will you actually collect that? Well, you're going to prorate year 3 by taking what you need by what you are going to earn. So 200 divided by 500 equal 4.40 of a year, or 4/10 of a year. So actually what you're saying is, I want to recover this money in 2.4 years. And this is another example of it here, showing you what payback calculations might be for different potential projects, and how you would compute those. Now, what are the are there problems with this rule? Are there issues with when we're looking at the payback periods? Well, one of the problems with payback is that we're really just looking at paying back the initial investment. We're not looking at income, and we're not considering the time value of money. This model really basically says all I'm concerned about is the time frame in which I recover my money. It also is arbitrary. I mean, there's really no what makes it different. Why should we say 3 years recovery time instead of 5? So it really doesn't make there's no logical reasoning behind, well, we have to choose this length of a cutoff period. Now, you may not want to use this method as an analysis, but there are some reasons that companies might use it. Large companies might use it if there's a very small investment and they're just wanting to do a thumbnail analysis of it. They don't want to get too deep into the weeds with the calculations, and they want to say, okay, well, should we do this and should we not? And it may be that a small investment or a short term, something that's very low risk or whatever, they might want to do it that way. But typically, they're not going to do this for a lot of the more major capital projects they're going to undertake. So here's basically pros and cons of the payback rule. Look at those. Another method is the average accounting return. This is basically taking some measure of profit that we're going to look at and comparing it to some measure of accounting value. Now, when we do that, we're looking at our net income. Here we have 100,000, 150, 50, and negative 50. We're going to take all those net incomes and we're going to calculate an average net income of 50,000. And the average book value here, we're going to take the average book value, which is we're purchasing or our investment is $500,000 over 5 years. So we're going to depreciate $100,000 a year, but we're going to take that book value, which is 500,000, and divide by 2. We have a zero book value at the end because we've used it all up. So we start with 500,000, and after 5 years, the book value is gone. So the average of that is 250,000. We're not going to really get into. We are going to calculate average net income, average book value. When we look at that, we have a 20% average accounting return. Now, if you have a target rate that's less than 20%, then you probably would go for this investment. Otherwise, it wouldn't be. So the average accounting rule is just basically this. Based on an average accounting return, a project is acceptable if the average accounting return exceeds a target or average accounting return percentage. And again, that may be rather arbitrary. The firm may decide, well, we want an average accounting return of 25% or 20% or whatever. The advantages are that it's easy to calculate and the information is always available, but it may not be. It's not a true rate of return. The time value of money is ignored, and it's arbitrary. The benchmark or cutoff rate. Well, how do you come up with whatever rate of return you want? Another method for estimating whether or not you take on a project is an internal rate of return. An internal rate of return rule says an investment's acceptable if the internal rate of return exceeds the required return, and if it doesn't, it should be rejected. So here's we're thinking about this. Let's think about this considering net present value, for example. If we wanted to calculate the net present value for a simple investment that they give us up here, we have we invested in a project for $100 and it pays $110 in 1 year. What's the rate of return? Well, the net present value of that, we got a negative 100 because it's outlay, plus 110, that's income, divided by 1 plus R, which is the rate of return. So we're going to solve for R in this case, and using this simple calculation, we get a 10% rate of return. If the internal rate of return on investment is a required return that results in a zero net present value when it's used as a discount rate. So basically what you're saying is this internal rate of return will calculate a zero net present value if it's used as a discount rate. So basically this is the way we would calculate it right here. If the net present value is zero and we had an investment of $100 and we had a return of 60 in the first year and 60 in the second year, what would that rate of return be? Well, here's how we calculate it. We take negative 100 plus 60, which is going to be a negative 40, divided by 1.1 plus 60 divided by 1.1 to the second power, and so we get $4.13, which is a net present value. That's close. That's not exactly it, but we're getting closer. A net present value is kind of it's a series of calculations to approximate what the rate of return would be. So here we have, in a specific case, we have different rates of returns, discount rates, and here are the net present values. We know that the net present value should be zero, so the discount rate should be somewhere between 10 and 15%, and basically it's at best an approximation, but it's going between those two. Now you see here, by graphing it out, the internal rate of return is 13.1%. If the net present value rule and the internal rate of return rule lead to identical accept and reject decisions, this is what's going to happen. We'll accept an investment using the internal rate of return if the required return is less than 13%. If the way this illustrates in this figure is if we get more than a 13% rate of return, or we need a greater rate of return out here, this results in negative, and we're not going to take it. If it's less than 13.1%, and what this is actually doing in an internal rate of return, you're looking at the break-even point. You're looking at the rate of return at which you would say, anything more than this, I can't do it. If I expect a rate of return higher, I can't do it. If it's a rate of return less than this, then I can. The decision-making process is going to be very similar to net present value. You can also calculate internal rates of return with a spreadsheet. Again, there are formulas in Excel, financial formulas. They show you these here, and you can actually use it quite easily to calculate things like this. Although I caution you with Excel and financial formulas, be sure you're aware of the formatting requirements because those can create different values than what you anticipate. So problems with internal rate of return come about when cash flows aren't conventional, or we're trying to compare with two or more investments to see which one's best. So non-conventional cash flows. We may have something that's not conventional. And here they talk about, suppose we have a strip mining project that requires a $60 investment. Our cash flow in the first year will be $155. In the second, the mine is depleted, but we have to spend $100 to restore the terrain. this figure illustrates both the first and third cash flows are negative. So in order to find the internal rate of return on this project, we can calculate the net present value at different rates. And again, you're looking at where is this going to come out at 0, net present value. Well, it's going to come out between 20 and 30%, probably closer to 30. And if you look at this, you have kind of a strange looking curve, but you have, if it's an internal rate of return less than 25% or higher than 33 1/3, you reject. It's in between. So I mean that's because this is an unconventional cash flow. It looks odd. The curve looks odd. So again, this is a problem where you have multiple rates of return. You may have more than one where the net present value is 0, and it can happen, especially in this kind of a case. Even if there's a single internal rate of return, a problem can arise concerning mutually exclusive investment decisions. If you have two investment decisions and one of them has to be chosen over the other, this internal rate of return really doesn't tell you which project is preferred. It basically tells you where your net present value is 0. So, and they illustrate the problem with the internal rate of return. So, given two or more exclusively mutually exclusive investment, which one's the best? The best one would be the one with the largest net present value. Can we also say that the best one has the highest return? Well, the answer is no in this case. The internal rate of return for A is 24% and for B is 21%. If they're mutually exclusive and we only take one, we would suggest investment A would be the better investment because of a higher return, but we may not be correct. So when we look at the net present value, we can identify the difference between the two investments. So intuition wouldn't necessarily be correct. So look at this with the investment B or investment A. We initially thought investment A, but looking at this, it would probably be a decision would be investment B. So if we're looking at internal rates of return, though, if we're really talking about that, we're not going to make this decision based on the internal rate of return, simply because the internal rate of return for Project A is higher at 24%, Project B is at 21%. But if you look at these together and then calculate the net present value, you're going to say the net present value of you're going to base it on the net present value. There are some things with internal rate of return that's redeeming, and it's very popular. It survives because it fulfills this need, basically. When you look at investing decisions, rates of return are more widely used rather than talking about net present value. There's also a modified rate of return, and it addresses some of the problems that come up with a standard rate of return. And basically, we go back to this illustration we used earlier where we have these cash flows. Now, the modified internal rate of return based on these calculations, you get 19.74%. So the required return on the project is 20%. The modified cash flows look like this. You said negative $60, negative $100 over 1.20 to the second power, because that's the required rate of return, 20%, and you're going to get a negative 129.44, and then a positive 155, and a negative, basically 0. So There's also a combination approach where you can basically modify that. Well, anyway, that's rate of return. But basically, the internal rate of return is closely related to net present value, but because a lot of investment decisions are based on rates of return, there may be some. This method is used widely. Profitability index is a benefit cost ratio, and what you're looking at is really deciding whether or not you take something on. It's related to net present value and generally leads to similar decisions. But with mutually exclusive decisions, it may lead to something less than optimal decision making. When we talk about practicing large capital budgets, or practicing capital budgeting, we need to really think about this in large scale terms. There's a lot of companies with large amounts of money and capital budgeting techniques. So if you look at these comparisons, you have payback period, you see it's diminishing in popularity, average accounting return, there's still quite a few users of that, internal rate of return, net present value, and then finally internal rate of return or net present value. And you see there's a very widely used number of folks using that, especially I guess this was 1981, so that's quite some time ago. All right, discount. So a summary of investment criteria. When we talk about discounting cash flow, we're talking about net present value. It's basically looking at the difference between what we will receive and what we are going to spend. The internal rate of return is a discount rate that really makes our estimated net present value of an investment equal to zero. And it could be considered the discounted cash flow return. It basically is a calculation that doesn't work well when we have mutually exclusive decisions. Modified internal rate of return is a modification to the internal rate of return, where you modify the cash flows by discounting negative cash flows back to the present and compounding all cash flows to the end of the project's life. So then you have profitability index is the benefit cost ratio, which really is a ratio of present value to cost. The profitability index rule is to take an investment if the index exceeds 1. Payback criteria, basically you're going to decide to do something if you get your money back within an arbitrary payback period. And then the accounting criteria is the average accounting return, and that is also an arbitrary cutoff, but you are calculating a return using a profitability measure divided by book value measure. So that's it for Chapter 8. Now when we get into the problems, and we're going to look at what you need to do. You want to answer 1, 3, and 6 in questions and problems. So when we're really getting here, let's go down to the questions and problems so I can show you what you're going to have to do. So here it is. 1 is calculate a payback. What's a payback period on these cash flows? 3, calculate the payback on this one as well. And then number 6 is calculating a net present value. So you can look at that calculation and go back to the early part of the chapter and look at that in the book. All right, that's it for Chapter 8, and soon Chapter 9 will be coming.